Welcome to the daily update, where I'll go over the action in the market for Friday, November 7th, and we'll see how things look for Monday, November 10th. Had a pretty impressive rebound. Now, if you just look at the end of day result for the S&P, it's like, we're up 0.13%. Not all that big of a deal. Well, we were screaming to the downside after the open, and we finally found support. And I think I picked out the index that we bounced off of. We lost the 50-period moving average on a number of different indexes, including the S&P. But with the Dow Jones Semiconductor Index, we just came right down to that 50-day moving average, bounced up, started bringing the other indexes back up with it, and staged a pretty impressive rebound and actually ended up closing positive after we were down pretty severely earlier on in the session. Now we're going to wonder about, okay, follow through. Is this the beginning of something? Has the market come down enough to warrant the smart money really coming in and continually buying after this? Has enough doubt been now placed upon seasonality for everyone to just assume that the market was going to go up and then we're going to have another third year in a row now with a 20% return on the S&P and this has just become automatic? Well, some real doubt has come in. Now, you look at our charts and we're still drifting more negative. We haven't switched over to positive. There's a few positive areas that I'll go through and talk about, but we're still leaning more towards the negative side of things. Before I get into the depth of the video here, I have a thing called the SPX investing program where the videos like this video, it's available right away there, where it's delayed on YouTube and Rumble. There are also additional videos that I post there with some trade ideas. You have access to me if you want to set up a time and talk on Zoom or something like that. That's what I enjoy doing. Now, there are two parts of this program. One is the main program, the spxinvesting.substack.com. Unfortunately, through Substack, you have to provide payment information, even though it's free until the end of 2025. But I'm not going to charge anything for that. Now, I set up a second website, which is spxvideos.substack.com, where you don't have to provide any payment information to be able to access that, but you don't get access to all of the additional information that I post. So it's kind of a balancing act there. But check it out and see if that's something that you find helpful to you. All right, so right at the open, we had a gap lower open. Now the futures were positive, and then they just drifted down and started to turn more negative. By the time we opened on Friday, we had a gap lower open. We went below 6,700. We also fell below S1 at 66.86. And we tried right after the open a bit of a rebound, but we hit resistance at S1. Then things really started to move to the downside. We declined below the 50-period moving averages at 66.69, and we fell below S2 at 66.52. Then things kind of shifted, and quite often you'll hear me allude to this. This is why I watch intraday charts. There's typically two parts to the market. It's the amateurs who open it, and they kind of hang around until about lunchtime or so. And then in the afternoon, that's when the smart money will come in. Those are the professionals, and then drive the market the way they want to go. And it was right about at the lunchtime when we saw the rebound begin to happen. And so that's quite positive in and of itself. But now, are we going to see follow through with this? So once we finally saw some buying coming in, we got back above S2, we got back above the 50-period moving averages, S1, 6,700, and even the unchanged level. We ended up closing slightly positive, but we were only up 1.3%. Doesn't sound all that impressive, but when you look at the chart, it's quite impressive. We were above average with volume. Now we're still negative in the short term. We lost the 20-period moving averages already. And we were in danger of going negative in the intermediate term, but that, at least for right now, the market's been able to hold on to that. And I'll go through a little about interest rates here in a moment and the dollar. We've been keeping an eye on that. Now, there's a lot of domestic things happening when it applies to the government shutdown. One of the catalysts that they're saying help drive prices back up is that there's a potential deal out there. But then not long after that, the deal's like, well, it's probably not going to happen. And so we'll see if something develops over the weekend. But I see this as more of a technical thing that's happening here. It's just some news kind of tended to happen right around that same time, and especially the financial media, they always want a cause and effect. The stocks went up or stocks went down because of this, and it doesn't always work that way. It's amazing to me over the years I've seen how the charts will start to show something and then news will break after that and they use one as the catalyst, the news as the catalyst for price action. But okay, anyway, so some comments. It was a very impressive reversal after falling below the 50 period moving averages. Now, this is the report that kind of got things buzzing here. There were reports that the Democrats will vote to reopen the government if the Republicans agree to a 1 year extension of the subsidies there. But then it's like, nah, Republicans aren't going to do that. It might be rejected. They'll say, okay, we'll talk about this, but let's get the government back open first. Now we're starting to deal with air travel and starting to hit home a lot deeper. A lot of this government shutdown is pretty much kind of hung out in the background, and at least from a stock market perspective. There's all kinds of people that have a very personal impact by this, but I look at this more as what does it impact the stock market and what will that do? Well, now you're starting to deal with air travel, and that's going to affect a lot of people that have to travel for business. And we've got Thanksgiving coming up at the end of the month, and that could be a real impact as well. And pretty much all the major cities have cut back on their flights now because they don't have air traffic controllers and they don't want planes bashing into each other. We already had a very sad thing happen earlier in the week, and my oh my. But that wasn't air traffic control related necessarily. But we don't want to feed into that anymore. Then mega caps did stage a pretty impressive rebound. Now, some of them still ended up closing lower, but they were well off of their lows earlier in the session. For right now, the 50 period moving averages are holding. So we're maintaining a positive stance in the intermediate term. We still have another spike, though. We had this confirmed Hindenburg-Ullman, and we're seeing a series of spikes with this. And the more spikes we see, the more we need to pay attention to this. And we have the Stochk RSI, which is extreme negative, and also the CCI 14 is continuing to drop. It's shorter term. I look at two CCI charts, 14 period, 20 period, and the 20 period is going down, but it isn't extreme yet. So we're seeing a little bit more of a buildup of the negative conviction in the short term. No change to the Fed. They really didn't play a role in Friday's session, at least that I could tell. The dollar was down slightly, which probably helped stocks later on. Now, the dollar's been going up, but it spent the last couple of days going down. And then interest rates were unchanged on the 10-year yield. We closed at 4.09%, so really no impact there, at least on a closing basis. And we did tick down. We're getting even more extreme negative. Now, when we drop below 25, we look at this sentiment as being a contrarian indicator. So if we get more follow through and sentiment is extreme negative, those two are lining up with each other. But a lot of our other charts, not really seeing that yet. We're going to need to see continued buying. But we're at 21 right now with sentiment where we were at 24. We're not trending still. Now, in the short term, we are starting to trend. We're crossing above the moving average, but I base things around the intermediate term. And the red line is above the green line. So this trend that seems to be developing is a negative trend, but it hasn't hit the intermediate term yet. And so we're still below the moving average, even though the ADX is trying to turn up. I'll show you that. And we're below 20. That's why we're not trending. Now, I have the bias at mixed. Now, it was impressive, but we're still seeing weakness building in some of our charts. And the momentum, I'm still keeping it negative. And we don't have a confirmed trend in the short term yet because we're still below 20, but we're starting to cross above the moving average. Okay, so we did get consumer sentiment, not really optimistic right now, even came in worse than expected. They thought it was going to come out at 54. It came in at 50.3. The last reading we had was at 53.6. And then if you go back a year ago, we were at a very optimistic 71.8, which is not all that great, but quite optimistic compared to how folks are feeling about things right now. Consumer credit is building up here. This is a bit of a concern. A lot of folks are struggling with the economy, even though on a stock market perspective, I mean, GDP is looking positive based on the forecasting that we're getting. The stock market itself has been doing quite well and just coming off of recent all-time highs. But then you translate that over to everybody's day in and day out life. Yeah, prices are coming down, but are people really feeling that? Gas prices have been coming down. Are people really feeling that? That's kind of putting people in a difficult situation where they're having to live off of credit. And we saw an expansion of 13.1 billion, much more than the 8 billion they thought was going to be the increase. And last time it was at 3.1 billion of an increase there. So here is consumer sentiment, not feeling all that optimistic. This is broken out into three areas. The blue line, that's the total reading, and that's the chart right after this that I'll show. That's going down. And then the purple line, how are people feeling right now? Not very good. And how are people feeling going forward? That's the yellow line. Not very good there either. So a lot of pessimism coming back in. Here's the other chart, which is also plotted with the 2-year Treasury yield, which has been coming down. But you can see folks are just not really optimistic about things right now. There's a lot of changes going on. Of course, if you like these changes, you think things are getting better. If you don't like these changes, you see things getting quite worse right now. All right, then consumer credit ticking back up here. It's still above the zero level here on a year-over-year basis. And then looking at how we've gone up and from the previous reading that we had, and you can see there's been a real increase overall of consumer credit on a month-over-month basis. All right, then this is change in liquidity, and then comparing it with the S&P 500. We've been in this band here, which is kind of shaded in red, and we've been going up, which is in green, where investors hope for a return of monetary accommodation, like QE, quantitative easing, and things that we saw during the whole COVID plunge that kept the economy going there. Well, for some reason, they're thinking something like that should happen again. Well, is that really realistic here? So this is starting to trail off a little bit, coming down about a bit out of this red band. All right, and then putting it in perspective, yeah, we've had a pretty low reading on average here, and we actually broke below that average earlier on. On a closing basis, they have it here at 18.9%. On an intraday basis, we were down about 21%, but we've also been going up. We're also positive on the year. Now, this is, again, not much of a change on Friday, but this is before Friday's session. And then buy the dips, low risk, high reward. I don't implement that. I don't think it's a very good strategy. You can be right 9 out of 10 times or 99 times out of 100, and the one that you're not right on could wipe out everything that you've done. So, again, you may have a different approach to that. We always like the idea of, hey, this is a good stock. I can get it on sale. Yeah, okay, that sounds good. But at the same time, what is a dip? Because a lot of people were buying the dip earlier in the week are now seeing pretty significant losses, even with the impressive rebound that we saw on Friday here. And this is measuring it here more on a percentage basis of how people have been doing. All right, valuations, we know this. We see charts like this that show it, sometimes more than one chart. Just looking at the earnings going forward here, the valuations, it's a combined PE ratio. Yeah, we're quite overextended, but we've been overextended for years. And then productivity is above the trend. Now that's positive. That shows that the economy is hanging on to doing pretty good. They're basing it around the light blue line, which is the pre-COVID trend, and how we're now outperforming that with the post-COVID trend, I guess you'd call that. And Bitcoin, yeah, I'm not all that active in these markets here, but it's been under pressure lately, and it's starting to drop below some pretty significant support. Now, there's rumblings out there. It's like, okay, now you have analysts getting involved and big money getting involved and smart money. And is Bitcoin really losing the independence that it's supposed to have? Because now there's all this pressure. There's ETFs that are involved in this, and it's like, okay, the original design of Bitcoin was that it was decentralized and it wasn't controlled centrally by any government. Well, that's things are starting to creep in that's putting that in doubt. And now you've got some people that are starting to bail on that. All right, then market-based inflation expectations still coming down, where you look at all the different maturity rates here going from 1 year up to 30 year, for the most part going down. And then the survey conducted by this research place here showed that a labor market unwind is the biggest risk to trading. All right, so labor market. That's they think that's why we keep a real close eye as best we can. We didn't get the employment report on Friday. We're now 2 months behind or two reports behind. We haven't been getting the initial and continuing claims. We've been getting other data. So we don't really know where that stands from a government report perspective, but we're holding up okay with some of the other reports that we've been getting out. So, and that's really what the Fed's been watching too, is what's the job market like? How's that holding up? Are we gaining jobs? Are we losing jobs? Okay. And then these are the whales. These are like people that got in a long time ago at the very beginning and they're just riding this out. According to this chart, it says those folks are dumping. The chart gives a good visual of how many of the super whales, all right, I don't know if I'd like to be called that, but they're cashing out of Bitcoin. All lines here are 7+ year on-chain spends of oh gosh, give me the acronyms here, going back to before 2018. But according to this chart, there's a lot of the people that have been holding on to this for a long time are starting to bail on it. And earnings per share growth, the takeaway here, at least in the top chart, we're going up, and that justifies stock prices going up. And then you look at the Magnificent Seven where they're leveling up, but this is still really the driving force in the stock market. And then you look at growth itself, and those are going up. So this is taken as more positive. It all comes down to earnings eventually. Then market cap and earnings. Again, we see this chart quite often here. 10 largest companies, 42% of the market cap, 32% of the earnings. All right, here's the chart where we did gap down, and a lot of the loss came right from the gap. We fell down below S1. We tried to come back up, but you can see how we hit resistance back up at S1. Then we fell down below S2. This is when we started to fall below the 50-period moving average, actually dropped below S2. And then things started to slowly improve at first. We got back above S1. We got back above the 50-period moving averages. We got back above 6,700. And then this is when things really kicked into gear even better, when we started to break back above S1. Now we came up to the unchanged level, which acted as resistance, and we kind of trailed along. But then right at the close, we saw enough of an upthrust to take the index positive for the day. And you can see here where we were coming down with the futures. We were actually positive in the initial overnight session, and then they just drifted, and then that just carried over into the cash session, bottomed, and then staged a pretty impressive recovery later on in the day. Now we're still not really changing the overall short-term tone here. We've been going down with the large cap growth to value intraday chart. Bigger picture though, we were going up, we started a plateau, but now we're rolling over a little bit, and we're still kind of in this recent range that we had been in. It's going to come down to follow through. We want both of these lines to go up. It would be even more positive if the blue line was above the red line. And a little bit of a bounce up here, but really not improving all that much with the growth to value chart intraday for the S&P. So yeah, I mean, we were looking quite bad there for a while. We did improve, but not enough to switch this back to positive. So growth still ended up being down, but well off of its lows, where value was up. So it was more of a defensive play. You'll see that when we go through the sectors here. Growth was up a little bit less for the mid caps and up about half as much for the small caps. So we're seeing a bit of a drop off here. Now the small cap growth to value ratio, end of day chart, still looking pretty solid, but the index just isn't really coming through here. We are seeing some weakness now in mid cap growth to value. This had been holding up the best, even though the index is the worst performing index lately. But this ratio still continues to go down, and now we're testing the 200-day moving average, and we're below the 200-day moving average with S&P growth to value. Now, to see the impressive rebound that we saw, we would expect this ratio to go up. It still is going down. So that's still building up more of a negative backdrop. And we're coming down into the top end of the rainbow, but still looking positive overall with this growth to value ratio. And we came down, we held at the 50-period moving average with the large cap growth ETF, and we bounced up off of that. And you're going to see a lot of this in all of the charts except for one. We actually dropped below the 50-period moving average. except for the Dow Jones Semiconductor Index. We just hit that spot on and bounced up. And still really not much of an improvement with discretionary to staples, still below the 50 period moving average. So our trend, we're starting to cross above the moving average in the short term. So that's a strengthening trend, but it's not a confirmed trend until we get back above 20. Now, this is a negative trend because the red line's going up and the green line's coming down. Even with the impressive rebound that we saw, the ADX is still picking up more negative than it is positive currently. And we haven't quite crossed. You have to look at the number here. We're at 16.54 where the moving average is at 16.65. So we're still just a little bit below the moving average here. And this is still looking more negative with the red line above the green line. And we were above average with volume, but it did taper off, but a little bit of a pickup from Thursday's session. Now, we're looking more negative here with gamma exposure. We flipped over. We were solid green earlier in the week. Now we started to go down and we're headed off into this red area. And we're below the gamma flip of 67.59. We closed at 67.29 here. So about 30 points below where we flipped from positive to negative. And again, this is using part of the Greeks that are used to analyze options to determine what's the exposure. And this helps us to determine the general positive or negative nature of things currently, as well as support and resistance. So we are seeing some support here at the 6,700 level. Now we lost that, but then we ended up getting that back. There's also some support here at the 6710, 6720, 6730. Okay, round numbers because these are strike prices here. But we are leaning more on the negative side currently. So there was an improvement, but not switching back to positive. And we're seeing fear picking up here with the ulcer index. We're starting to come back above the moving average. And we were above 20 with the VIX. If you look down at the bottom with the bar chart, we were quite, in fact, it was right into the close where we finally dropped down and closed at the low for the day for the VIX. So on a closing basis, yeah, we came down a little bit, but we spent most of the day above 20 with the VIX and not really sticking with the seasonal pattern currently here. And saw a big shift here with the volatility of the VIX, both with the bar chart, we're above the moving averages. And we came down a little bit, but we're still above the moving averages with the line chart, which is just the closing value. So we went up with this fear gauge, where we declined a little bit with this other fear gauge. So a bit of a contradiction there. And we are going up with the equity put call ratio daily chart. We're still going up with the 5-day chart and the 10-day chart. So that hasn't switched from being more negative, which is what it is when these 5 and 10-day charts are going up. It hasn't switched over to positive. And haven't seen much of a change here. We're still underneath the band with volatility risk premium. So we did see a bit of a tick up with the advanced decline line based on price and volume after we've been seeing some recent weakness. And we're back above zero with the advanced decline ratio, both the short and intermediate term, which is the blue and the red lines here. And we crossed barely back above zero here with the short term advanced decline ratio based on price, seeing it a little bit more positive here based on volume. Where in yesterday's video, we were dropping negative with both of these. So that's also pretty impressive. And a little bit of a tick up, but not much of a change. We're still negative with the advanced decline oscillator since we're below zero. And still not really seeing any improvement here internally. A drop off in the new highs. We have been seeing a bit of an expansion of the new lows. So we're going down with the 5-day chart and 10-day chart here internally with the new highs minus the new lows. And we're just barely trying to get back up to the moving average with accumulation distribution. But in the shorter term, we ticked up, but we're still below a declining moving average. This is still negative, but this is our only smart money indicator that's now negative, where we're actually turning back to positive with the Chaikin money flow. We came back above zero. It's green again, and now the red line's going up. And the Chaikin oscillator also turned up and is above its moving average. So 2 out of the 3 have switched back to positive. So there was some healthy buying that came in. But we're negative now with the vortex. It was our last primary indicator to hold out being positive. Now we're seeing the red line crossing above the green line. And we did improve a little bit. We came just a little bit above the moving average with the advanced decline line. This is a shorter term moving average with the S&P, but we're still below the moving averages with all the other indexes, the NYC common stock, mid caps, and small caps. And we're still looking more negative. This is longer term and broad in scope here with the 5-period moving average of the highs minus the lows. That's still showing some weakness there. We improved, but we're still below 50 with those stocks above their 20 period moving averages. Also, still below 50 with the 50 period moving average steady, 100 period moving average steady. And we never did drop below 50 with the 200 period moving average steady. This is holding up a little bit better. It did bounce up slightly on Friday. So you notice how we came down to this pivot point? This was already on the chart beforehand. This is another thing that I was watching on Friday where we came right down to this level, and that's acting as support. We fell below the 50 period moving average, but then we're able to get back above it. And on the bottom, we saw a bit of a pickup from Thursday, but still we are above average with volume. So a bit of an improvement with the 20, 50, and 200 period moving averages on the S&P. Still extreme negative with the Stochk RSI. This and the CCI chart right after this are really the only charts that are showing negative conviction right now. And we ticked up a little. We never were showing negative conviction what the Williams percent are. Here's the CCI 14 chart, which is starting to go extreme. We're coming down with the CCI 20, but not extreme yet. And not really seeing much of anything here. In the short-term stochastic, still negative with the intermediate and long short-term stochastic. And bit of a bounce, but still below zero, still below the midpoint with the force index. And we came right back up to the 30 period moving average here after this is shorter term. We're still below the 10 and the 20. And we're still seeing more vulnerability. Even though this is a nice looking green bar here, you take the context of what's been happening, we're still seeing lower highs and lower lows. And that's starting to show more vulnerability with the short term trend based on 20 periods. And we're still below the 20 period simple and exponential moving averages, still below the midpoint in the -1 channel. Went all the way down into the -2 channel with the standard deviations chart, but came back up into the -1. Then we switch over to intermediate term, still going down. Balance of power still has things looking more negative. We're still looking more negative with the go, no go, lighter blue bars. Still below the midpoint, starting to hit the red line here, at least on the intraday basis, but we bounced up off of that with the lowest low value. And we stopped having an uptrend here according to the Landry Light. We're at zero now. So I'll have to see, is this going to switch over to negative, or is it going to be able to turn back over and show a new positive trend? And we are still in a positive trend with the proper order. We were going up, it stopped, delayed for a couple of sessions here, and now we're back into an uptrend again, where we're still seeing a decline with the TTM squeeze, darker blue and declining. And we're just barely above the moving average with standard deviation. We've been moving kind of quickly. That started to fade after we got beyond these gaps as being part of the calculation. Now we're starting to move again, so the standard deviation is picking up. And again, this measures speed, not direction. And we're still negative with the ease of movement. No change. The Arun took the day off. It also took Thursday off as well. An improvement, but still below zero with the S&P McClellan oscillator. So we're still going down with the summation index based on price and volume. An improvement, but still below zero with the NYSE McClellan oscillator. Declining with the summation index based on price and volume for the NYSE. This has been positive over the last few days, though. The swollen trading oscillator still advancing based on price and volume. Below zero, but improving here. So that's one of the kind of the outlier positive charts that we've been seeing over the last couple of days. But momentum is now shifting more negative. The PMO is below its moving average and declining. We're also below the moving average based on price and volume. Bit of an improvement, but still below 50 with the PMOs that are rising. A little bit of a tick up, but also below 50 with the buy signals. And leveling off, but still declining below 50 here with the PMOs that are above zero. Still negative though, even though this is a nice looking bar. Open, we came down, set the low, closed at the high for the session, and but still red. Still, when you take it in the context of a daily chart. Negative still for the second day now with the parabolic SAR. Short-term momentum rolling over below the moving average with the slope oscillator. Negative in the short to somewhat intermediate term with the MACD. So we're looking more negative here. We're seeing more of a confirmation with the slope and TSI. The short-term oscillators are now declining. All three intermediate term oscillators are declining, and we're rolling over, hanging on to barely being positive with the two long-term oscillators. And we're still negative with the Copic curve. here, and we're declining with the Sean trend meter. We're declining, but above 50 with the money flow. We're improving, but below 50 with the ultimate oscillator. Still above the moving average with unbalanced volume. And just a little bit below 50 with the intermediate term RSI and a little bit more below 50 with the short term RSI. A tick up, but not a switch back over to positive. And we're still declining with the bullish percent index, even with the reversal. Now, these are point and figure charts. They just measure price. They don't measure time. So it could be that a lot of the bounce that we saw on Friday was not picked up. It was registering sell signals in the morning, and then there wasn't enough of a reversal to start to put buy signals back in. So this is still declining overall below the moving average and also below 50. Also turning more negative here with the NYSE bullish percent index, we drop below 50 and we're below 50 with the NASDAQ 100 bullish percent index. Seeing a bit of vulnerability. We've had 4 days below the intermediate term trend based on 50 periods, starting to roll over a little bit here, even as impressive as Friday seemed to be. But we've fallen down here before and we're able to get that back. And so now that's what we're asking. Is this time also, are we going to be able to get that back as well? And here is the big one, the 50 period moving averages. We fell below it, but we were able to close back above it. So we're below the 20s. That's why we're negative in the short term, but we're above the 50 still. That's where we're positive in the intermediate term. And we didn't quite get down to this anchored weighted moving average here, but that was still below current price and might have acted as support if we saw more of a decline. We didn't quite get there, at least in Friday's session. And still working off of a mass index reversal, which so far seems to be legitimate. And then in opposition to that is a praying bottom fisher buy signal, which, okay, you would have bought almost at the top here. Not a real good signal there. All right, and we're still coming back up into the lower end of the mini rainbow here with the open, high, low, close chart. And we were down 1.63% for the week. Still looking okay, even with this bar and being down on the week. We're still, for the most part, not quite a higher high here, but we're not really setting much of a lower low at this point. We'll see if the integrity of these bars gets challenged going forward. And we are looking negative here with the Heiken Ashi. We're actually turning negative now with the Kegi chart, turning negative with the Renko chart, and negative with the three-line break. So we were getting a mixed picture. Now our different trending charts are starting to switch over negative. And we had enough of a downward move and not enough of a bounce where we saw a couple more red O's come in here. And we have a high pole warning, which was generated back on the 6th. So the point and figure chart is turning more negative currently. Long term saw a little bit of a tick up here, but we're above the midpoint with the 150 and 200 moving average study. So still negative in the short term with the S&P mid caps and small caps, and still negative in the short term with bonds based on price. Commodities are positive across the board. Still seeing an uptrend with the short and intermediate term US dollar index. And notice here, communication and tech. Now they came well off of their lows, but they still closed down. Discretionary was up, but not very much. But you see the areas that did the best, staples, energy, utilities, real estate, these are defensive areas. And they're the ones that really saw the love on Friday and ended up going up and performing better. So an awful lot of red. A lot of this was earlier in the day. You notice it came up to 11:56 a.m. where we're just going down, down, down. We initially started with a BPI cross above 50 with the healthcare sector, and then we did drop below 6,700 with the S&P, and then it was a countdown here, 29 or 23, 29, 22.9, 22.8, 7, 6, blast off. The euro was starting to see a bit of strength compared to the dollar. Canada ended up closing down below 30,000 here, and we had a BPI cross below 50. That's the chart that I showed a few minutes ago here. No, I didn't show this chart. It was the NASDAQ 100 that's below 50. All right, and then kind of not really much change here, but much improvement overall. Google stocks ended up being down. Eli Lilly, which saw some love on Thursday, didn't get much love on Friday. Amazon was up a little, but Tesla got hit. You know, it's like, okay, Elon, we'll give you $1 trillion. And then here's the Dow, where it didn't quite get down to its 50-day moving average here. Now, in the bounce back up, it's hitting the underside of this pivot point. This is the kind of the line in the sand for the month, whether we're positive or negative. We're still leaning more negative with the Dow since we're slightly under the pivot point. Still negative with the Elder's Impulse system. Came down, dropped a little bit below the 50 period moving average, hit at about this pivot point here, and then bounced up with the NASDAQ, but still negative with the Elder's Impulse system. Also, came down and we saw a bit of a convergence here with the NASDAQ 100. This pivot point in the 50 period moving average, they're not right on top of each other, but they're pretty close to each other. And then we were able to come up off of that. Still negative though with the Elder's Impulse system. Momentum is negative for the NASDAQ 100. We did come down, drop a little bit below the 50 period moving average, and then come up from that. But we're still below the 20 period moving average with the QQQs, which is the ETF for the NASDAQ 100. And the small caps with the S&P 600 came back up, but now we're right back up to this pivot point in a very similar situation as the Dow, just a little bit below the pivot point. And that's the line between positive and negative. We're still below the 50 period moving average with the Russell 2000 index here. We were up over 0.5%. Nice little bounce, closed at the high, but we're still below the 50 period moving average here and still negative with the Elder's Impulse system. Mid caps came right up to this pivot point again and still below their 50 period moving average, but actually switched over to positive with the Elder's Impulse system. The Wilshire lost its 50-day, got it back. Total US stock ETF lost its 50-day, got it back. Financial sector up 0.71%, but still below its 50 period moving average. There's a bit more of an improvement here with the ratio between the financial sector and the S&P, but it's got a lot of work to do to start to outperform. FANG index lost the 50 period moving average, got it back. So Apple was down almost 0.5%, and we had Amazon up a little over 0.5%. Microsoft, it's been getting hit hard. It ended up virtually unchanged, but closed well off of the lows, where Google was down over 2%. And then Meta still having some trouble here, but closed at its high on Friday and below its 200-day moving average. And we started to drop below the 50 period moving average with Nvidia. It was down pretty fierce, and it ended up closing slightly positive on the day. And then Tesla came down to its 50 period moving average. So far, it's staying above that, but it was still down 3.68%. We're still below the 200-day moving average with Netflix. And this is the one that I'm picking out here, the Dow Jones Semiconductor Index. We just about hit that spot on. Now, the other indexes fell below their 50 period moving average. This one so far is holding. And this is tech, and this is semiconductors, which is a big part of tech. That's what we're going to be watching on Monday. How are the semiconductors performing? Are they going to start to outperform, or are we going to lose the support that was held at least in Friday's session? And now we're finished with the week, still below this resistance level when we look at the gold to S&P ratio. Ticked up here, we're still up into the high 59s as far as oil. And after getting above 100, we are dropping back here with the US dollar index. And we virtually unchanged with the 10-year yield, both based on the yield and based on price here. And still below the moving average with Qs to S&P, and below the moving average with discretionary to S&P, below the moving average with large cap growth to value. So not a lot of improvement with our growth to value ratios. We're below the moving average with the large caps, mid caps. Not looking very good there. We're looking better here with the small caps. They declined, but they're still above an advancing moving average. And then we have another spike here with the Hindenburg Almond. And I'll see over the weekend the perma bears that just salivate when we get even close to something like this and declare it as a done deal. Well, the last I saw from one of the perma bears that I kind of very loosely keep an eye on, it's like, well, the success rate isn't all that good. Maybe we shouldn't trust it this time. We'll see if that person is changing their tune this time, because when we see a cluster of these like we're getting now, it's very similar to what happened but right before the COVID crash, and it also happened at the end of 2021 before the bear market of 2022. All right, so we're still negative in the short term, we're positive in the intermediate and long term, and we don't have any economic reports that are scheduled. Now, Tuesday is Veterans Day, and I'm pretty sure the bond market is closed, but the stock market is still open. At least that's traditionally what it's been. It's like, well, the federal government shut down, so does that mean there's federal holidays are shut down too? I don't know. So yeah, the government shutdown continues. We'll see if anything breaks over the weekend. And then anything geopolitical going on here, either domestically in the US or something happening in the Middle East or between Russia and Ukraine. And have no idea how we're going to stick to this calendar. This calendar is also a little bit different here. Who knows? With the government shutdown, we really can't rely on these calendars. Now, when we look at November 10th, that's Monday. We're positive for the Dow and S&P, and we're neutral to positive with the S&P. We still have another week to go before we get into options expiration. And here is the seasonality, which we really haven't been sticking to all that much so far in the early part of November. This also shows, again, first half, second half for November perform well. This is positive seasonality going into the end of the year. Also, after the Fed cuts rates, we tend to dingle dangle around sideways and then possibly go up from there. But we're still waiting for that part to happen. And also positive seasonality here during post-election years. This chart also shows positive seasonality. This also shows positive seasonality. But there's positive seasonality historically, and then there's reality. And we're seeing a little bit of reality that's differing from what historically has happened, at least up to this point. And we're wondering now, the reversal on Friday, is that enough to shift everything and turn it back more positive? Our charts are not turning positive yet, but we saw that pretty impressive bounce. And we're starting to drop off here as far as the companies that are on blackout because they're reporting earnings. So we're negative still with the S&P and NYSE McClellan oscillator and summation indexes. Parabolic SAR is negative. Momentum indicators are negative. Ultimate oscillator is negative. Bullish percent index is negative. Vortex and the momentum for the NASDAQ 100 is negative. And we have this additional spikes with a confirmed Hindenburg omen and this mass index reversal signal that seems to be playing out, at least to this point. Now, our three smart money indicators, I have them over on the positive side. You might still say accumulation distribution is negative. We haven't quite crossed above the moving average on the bigger, longer term chart, and we're still below the moving average with the shorter term chart. But we are positive with the Chaikin money flow and oscillator. And then the growth to value ratios. Shorter term, they're negative. Longer term, they still continue to be positive. Swell trading oscillators positive. Ease of movement, money flow, financial sector, but it's bouncing up, but it's got a long ways to go to repair some damage there. And the long-term special K chart as well. Now, I've been including this. A lot of times it's like, okay, this is interesting to know, but doesn't really matter. Right about at this green pivot point here, which is a Fibonacci pivot, that's where we bottomed. And that's where the semiconductors bottomed. And then we came up off of that and we got back above this other pivot point here. So another point that we knew about ahead of time, we knew the 50 period moving average for the Dow Jones Semiconductor Index. And so as we were dropping below moving averages based on 50 periods, I'm looking through all these charts to say, okay, which 50 period moving average is still holding? And that's when I found the Dow Jones Semiconductor Index. And then this chart was also holding as well. So it's just that's because it's not always going to happen in the S&P, even though it ultimately plays out in the S&P. And then here are the pivot points for Monday's session. So our conclusion, still negative in the short term, positive in the intermediate and long term, since we're below the 20 period moving averages. Still seeing a buildup of negative momentum. And the trend in the short term is developing now, but it's not confirmed. And we're still positive in the intermediate term, where we're seeing more weakness still continuing, and we're not trending there. And we're still positive in the long term, but we're below that 10% level when we measure the distance away from the 200 period simple moving average. Thank you. I hope you found this helpful. I hope you have a wonderful weekend, and I will talk to you in the next video.